Jeremy Siegel, Wharton Professor Emeritus and WisdomTree Chief Economist, says this is not 2020 and that the economy is much stronger than most people think right now. In this video, I'm going to show you his latest interview on CNBC Squawk Box, where he breaks down the state of the economy, what to expect from the Fed, the impact of the Iran situation, and where interest rates could be headed next. After that, I'll give you my full breakdown and reaction to what he said, and then we'll dive into 3 stocks that I believe are positioned to win in this market. Make sure you like the video, share it, and subscribe so you do not miss the next major investing update. Let's hear what Jeremy Siegel had to say.
Jeremy Siegel, professor at the Wharton School. Professor, so good to have you. You know, you called it right, as always, on Friday when you said, look, these inflation numbers that we're going to get today probably going to come in as expected or maybe even better. What did you see from that reading that you found interesting, and then what do you expect from the Fed this week?
Well, I agree with Roger. We're not going to see anything this week. Honestly, I don't think we're going to see anything until we get Kevin Warsh taking over in the June meeting, unless there's a big deterioration in the job market, which we don't have any evidence at the present time. I also wanted to comment that some people are saying, oh, is this a supply shock such as we had during COVID and the Fed didn't get ahead of that, it was behind that? This is 100% different, and let me tell you why. Right after COVID, we had the biggest fiscal stimulus bill since World War II. Yeah. And in the 2 years from March 2020 to March 2022, Jay Powell engineered the biggest increase in the money supply that we had in 150 years. We don't have any of that now. And so I do not think that, obviously if we spike very high, there's going to be a ripple. But I think the Fed has got to look through this. The market today seems to be telling me, hey, maybe there's some good news on the horizon. You look at the market; they seem to sense something. One of your previous guests said that almost half the oil through the Strait of Hormuz is now going through pipelines, which I think is really quite amazing. But I think we should have 2 cuts later on in the year. But my God, there's so much between then and now that I think the Fed is completely in a wait-and-see environment.
Yeah, and you mentioned the optimism of these markets up this morning despite all the headlines. This divergence between the geopolitical volatility and these buoyant markets perhaps hasn't been this stark in a long time. We're talking this morning. Does that reflect composure or does that reflect complacency? What's your view of whether the markets are really pricing the risks right now?
I think they are pricing the risk. I mean, certain countries like Dubai is in a bear market now, and I think they just went down 20%. But, we're basically energy self-sufficient. We're going to get the rise in oil prices, but look at the dollar has gone up almost 5%. We don't talk about the fact that is lowering the price of imports which is going to cushion that inflation number somewhat. On the other side, we are so much in a better position than the rest of the world or where we were 10 years ago, 20 years ago. And I'm old enough to remember 40 years ago in 1980 when that oil went up, and boy, we were in one of the worst recessions we ever had because, we were importing half of our oil. So we are just in a so much better situation. And I think the market thinks we do have the upper hand here in Iran. And they're going to come to a deal, and it might be this week. That would be positive. Of course, a lot of tail uncertainty here, but certainly something, the market's thinking something right now, I believe.
So you're not as concerned about inflation right now?
No, because I think once you look through this oil situation, the major factors, I mean, one of the biggest factor in inflation is actually shelter. And rentals on the national index have actually been totally flat over 2.5 years. The Case-Shiller or home price index, so we're talking about owner-occupied, has been up 1% to 2% because of the way the government puts these in the data. it's really lagged, but that's a tailwind to lower inflation over the next really year and a half. So, yeah, I mean, oil is going to come through. There's going to be 2 or 3 tenths that is going to come through. But because, credit isn't being expanded excessively, and because fiscal stimulus is just not there, we're just not going to get this as a big inflationary impulse.
And Professor, I mean, you mentioned we're in a better spot, certainly, than decades past. We have previous oil spikes. Of course, we were at $100 oil in nominal terms in 2008 when the economy was much smaller and obviously consumers had less to spend. On the other hand, relative to what we expected this economy to be doing in the early part of this year, there's been a significant revision. This is going to be more friction in the economy. Everyone's been hyping a big tax refund season for 6 months, and we're spending most of that to basically pay for energy. It was never going to be that huge a swing factor, and now it's muted. So I think it just sort of it caused the market to adjust what kind of an underlying economy we're going to have this year. Where do you think that is landing?
Well, I think that's one reason why, we do have, we're in the pullback territory, I guess 5% for S&P, although open looks like we might nudge above that. That's why there has been somewhat of an adjustment downward. But if you looked at the major, Goldman Sachs, JP Morgan, they're taking 2 tenths off, maybe 3 tenths off of GDP. We take a look at the oil futures market. We're back down in the 60s. By the end of the fall, again, things could blow up. But at least in terms of what the markets and the flows are right now, this is not going to. It might offset that tailwind, but there's still a lot of good things going on in the economy.
And lastly, Professor, you mentioned that Warsh taking over in June. I mean, There's been a lot of headlines about the subpoenas and Attorney General 𝗗𝗟𝗏 saying, look, she's going to appeal those decisions. This could actually end up remaining Powell for longer in that seat. What do you think is going to happen, and how could that affect where we see rates headed for the rest of this year?
Well, let me give you my opinion here. I think it's 100% that Warsh is taking over. I mean, I don't understand why Trump, is pursuing anything now unless he fears that Powell is going to stay on. Now, very honestly, I would not stay on if I were, quote, demoted from chair to a regular FOMC. It's almost unprecedented. So he's going to be leaving anyways, I don't understand what the pursuit is anymore on that issue. So, my feeling is it's going to be worked out. Warsh is going to be taken over for the June meeting, and I think that Powell will not continue on at the Fed afterwards, and so this whole issue will die.
Right from the start of the interview, the tone is surprisingly calm. The market is up, oil prices are coming down, and there is this underlying sense of optimism despite all the geopolitical tension in the background. And honestly, that contrast is the first thing that stood out to me, because we are in a moment where headlines are screaming uncertainty. You have tensions in the Middle East, concerns about oil supply routes like the Strait of Hormuz, and yet the stock market is behaving like none of that really matters. And Siegel leans into that idea. He basically says the market might actually be seeing something positive ahead. Now, personally, I think that is where things get interesting, because markets do tend to look forward, not backward. But at the same time, markets can also get overly confident. So when Siegel says the market is sensing good news, I take that seriously. But I also think this is where you need to stay sharp as an investor. Then he shifts into inflation, which is really the core of this entire conversation. And this is where his main argument comes in. He says this situation is completely different from what we saw during COVID. Back then, you had massive fiscal stimulus and a huge expansion of the money supply engineered by Jerome Powell. That combination is what drove inflation higher. But today, according to Siegel, we do not have that same setup. There is no massive stimulus flooding the system. Credit is not expanding aggressively. And that is a key point he keeps coming back to. In his view, without those ingredients, inflation simply does not have the fuel to spiral out of control. Now I actually agree with him on that part. If you strip away the noise, inflation is not just about prices going up, it is about excess money chasing goods and services, and if the money supply is not exploding, then structurally inflation should stay contained. But here is where I think you have to add nuance. Just because inflation is not spiraling does not mean it disappears. What Siegel is essentially saying is that any inflation we see from oil is temporary. He even estimates it might add just a few tenths to inflation. And that might be true in a clean scenario, but markets are not always clean. If oil spikes hard enough or lasts long enough, it can start to bleed into other parts of the economy. Transportation costs go up, goods get more expensive, consumer sentiment drops. So while I agree with his base case, I would not dismiss the ripple effects too quickly. Another major point he makes is about the Federal Reserve. He basically says do not expect anything meaningful in the near term. The Fed is in wait-and-see mode. And honestly, that lines up perfectly with what we have been seeing. No urgency, no aggressive moves, just patience. He even suggests that rate cuts could come later in the year, maybe 2 cuts, but emphasizes that there is a lot that can happen between now and then. And this is where I think his perspective is very realistic, because the Fed right now is trapped between 2 risks. If they cut too early, they risk reigniting inflation. If they wait too long, they risk slowing the economy too much. So staying on pause is actually the safest move for them. Now, one of the most important parts of the interview, in my opinion, is when he talks about the divergence between geopolitical chaos and strong markets. The interviewer asks a great question. Are markets composed or are they complacent? And Siegel's answer is basically that markets are pricing risk correctly. He points out that not all markets are doing well. Some regions are actually in bear market territory. He also highlights that the US is in a much stronger position than it was decades ago, especially when it comes to energy. And that is a big deal, because if you go back to the 1980s, oil shocks had a devastating impact on the economy. The US was heavily dependent on imported oil. Today, that is no longer the case to the same extent. So when oil prices rise now, the impact is cushioned. He also brings up the strength of the dollar, which has risen significantly, and that is something a lot of people overlook. A stronger dollar makes imports cheaper, which helps offset inflation. That is a subtle but very important point. And honestly, this is where I think Siegel is adding real value. He is not just looking at one variable. He is connecting multiple forces that are working together to stabilize the system. But again, I would add a layer of caution here, because a strong dollar can also hurt multinational companies and exports. So while it helps on the inflation side, it is not a pure positive across the board. Then we get into one of the most underrated parts of the inflation discussion, which is housing. Siegel argues that shelter costs, which are a huge component of inflation, have actually been flat or growing very slowly. And because of the way inflation data is calculated, there is a lag effect. So what he is saying is that we are about to see a tailwind where housing data starts pulling inflation lower over the next year or so. This is a big deal. Because if he is right, it means inflation could cool even without aggressive action from the Fed. And I think this is one of the strongest points in his argument. Housing has been a major driver of inflation, and if that pressure is easing, it changes the entire outlook. But again, I would not take it as guaranteed. Housing markets can shift quickly depending on interest rates, supply, and demand. So while the trend may be favorable right now, it is something that needs to be monitored closely. Then toward the end of the interview, the conversation shifts to economic growth. There is this idea that the economy might not be as strong as initially expected. Some of the expected boosts, like tax refunds, are being eaten up by higher energy costs. So instead of fueling consumption, that money is just covering higher expenses. And Siegel acknowledges that there has been a slight downward adjustment in growth expectations, but he does not see it as a major problem. He points out that major institutions are only trimming a small fraction off GDP forecasts. Oil prices are expected to come down later in the year, and overall, he still sees a lot of positive momentum in the economy. Now, this is where I think his optimism really shows, and I get it. Because when you look at the data broadly, the economy is not collapsing. It is slowing slightly, adjusting, but still holding up. But I also think this is where investors need to be careful not to get too comfortable, because markets often look strongest right before they face new challenges. That does not mean a crash is coming, but it does mean you should stay disciplined. Finally, the interview touches on the future of the Federal Reserve leadership. specifically the transition from Jerome Powell to Kevin Warsh. Siegel seems very confident that Warsh will take over, and he even questions why there is still uncertainty around it. And this is more important than it might seem, because leadership changes at the Fed can shift policy direction. Even small changes in tone or strategy can have major effects on markets. So while this part of the conversation is more political, it still matters for investors. When you step back and look at the entire interview, the main takeaway is this. Siegel is telling us that the current environment looks risky on the surface, but structurally, the economy is much more stable than it was in past crises. Inflation is not being fueled by excess money. The Fed is not under pressure to act aggressively. The U.S. is in a stronger position on energy, and key components like housing are actually pointing toward lower inflation ahead. But at the same time, there are still uncertainties. Oil prices, geopolitics, economic growth adjustments, and potential changes in Fed leadership. So if I had to sum up my own take on what he said, it would be this. The foundation of the market looks solid, but the environment is still fragile. And in moments like this, the biggest mistake investors make is assuming that calm markets mean no risk. Because sometimes the calm is exactly when you need to be paying the most attention. Now let's dive into the stocks you should consider buying now that win in this market. The first company is Palantir Technologies, ticker symbol PLTR. Now before we even talk about the numbers, you need to understand why this business matters. Palantir operates at the intersection of data, artificial intelligence, and national security. It builds software platforms that help governments and large organizations make sense of massive amounts of data and turn that into actionable decisions. This is not optional technology. This is mission-critical infrastructure. When governments need to track threats, manage logistics, or analyze intelligence, they rely on platforms like Palantir. When large enterprises want to optimize operations or improve efficiency, they increasingly turn to data-driven systems like the ones Palantir provides. And this is where the moat starts to become clear. Palantir is not just selling software, it is embedding itself deeply into the operations of its customers. Once its systems are integrated, switching becomes extremely difficult. That creates long-term stickiness. And in a world that is becoming more data-driven every single year, that kind of positioning is incredibly valuable. Now here is where things get even more interesting. Palantir has been shifting from primarily government contracts into commercial growth, and that transition is critical because it expands its total addressable market significantly. The company has been gaining traction with businesses that want to use artificial intelligence to improve productivity, reduce costs, and gain a competitive edge. And this is happening at a time when AI adoption is accelerating globally. So you have a company that already has credibility with governments now expanding into the private sector at exactly the right time. That is a powerful combination. Now let's talk about the financial side. Palantir has moved into consistent profitability, which is a major milestone for the business. It is generating strong cash flow, and its margins are improving as it scales. Revenue growth has remained solid, particularly on the commercial side, which shows that its strategy is working. And this is important because it shifts the narrative. This is no longer just a speculative growth company. It is becoming a real business with real earnings power. And when you combine that with its positioning in AI and data infrastructure, you start to see why it can outperform in this type of market. Now here is the key point. In uncertain markets, companies that provide essential capabilities tend to hold up better, and Palantir is becoming essential to both governments and enterprises. That gives it resilience. But I want to be clear about something. This is not a risk-free investment. The stock has had periods of volatility, and expectations around AI can sometimes get ahead of reality, so you need to be disciplined and think long-term. But if you believe that data and AI will continue to shape the future, then Palantir is positioned right at the center of that trend, and that is why it makes this list. Now before we move to the next company, I want you to think about this. How many companies are actually building the backbone of decision-making in the modern world? Not many. And that is what gives Palantir its edge. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the second company. The second stock that is quietly winning in this market is 𝗗𝗓𝗏, ticker symbol GRC. Now this is a completely different type of business compared to Palantir, and that is exactly why it is so interesting. 𝗗𝗓𝗏 is a manufacturer of pumps and pumping systems. That might not sound exciting, but this is one of those businesses that operates behind the scenes in critical infrastructure. Its products are used in water supply, wastewater management, industrial applications, and even in sectors like agriculture and construction. In other words, it plays a role in keeping essential systems running. And this is what makes it powerful, because no matter what is happening in the economy, water still needs to be moved, systems still need to operate, and infrastructure still needs to be maintained. This creates a level of demand that is far more stable than most industries. Now here is where the moat comes in. 𝗗𝗓𝗦𝗖𝗢𝗗𝗘 has decades of experience, strong engineering capabilities, and long-standing relationships with its customers. This is not a business that can be easily disrupted. Its products are often mission-critical, and reliability matters more than anything. When you are dealing with water systems or industrial processes, failure is not an option, so customers tend to stick with trusted providers. That creates recurring demand and strong customer loyalty. And in a market where uncertainty is high, that kind of stability becomes very attractive. Now let's talk about the financial side. 𝗗𝗓𝗦𝗖𝗢𝗗𝗘 has shown consistent revenue growth over time, supported by demand from infrastructure and industrial markets. It also generates solid cash flow and maintains a relatively strong balance sheet, which gives it flexibility. One of the key things highlighted is its ability to maintain profitability even during challenging economic conditions, and that is exactly what you want in this type of environment. Because when markets are volatile, companies with steady cash flows and essential products tend to outperform. They may not have explosive growth, but they provide consistency, and consistency compounds over time. Now here is something that a lot of investors overlook. Infrastructure spending is not going away. Governments around the world are investing heavily in water systems, energy, and industrial upgrades. And companies like 𝗗𝗓𝗦𝗖𝗢𝗗𝗘 are directly positioned to benefit from that. So while it may not be a flashy stock, it is tied to long-term trends that are very real. And sometimes the best investments are the ones that people ignore because they are not exciting, but those are often the ones that quietly deliver results. Now think about this. In a world where everyone is chasing the next big thing, how valuable is it to own a company that simply keeps working, generating cash and serving essential needs? That is the kind of stability that can anchor a portfolio, and that is why 𝗗𝗓𝗦𝗖𝗢𝗗𝗘 makes this list. Now let's move to the third company, and this one brings everything together in a very powerful way. The third stock that is positioned to win in this market is Hubbell, ticker symbol HUBB. Now just like 𝗗𝗓𝗦𝗖𝗢𝗗𝗘, this is not a flashy company that dominates headlines. But once you understand what it does, you start to realize how deeply embedded it is in the modern economy. Hubbell operates in the electrical infrastructure space. It provides products and solutions that support power distribution, grid modernization, and electrical systems across utility and industrial markets. And this is where the real opportunity lies. Because we are in the early stages of a massive transformation in how energy is produced, distributed, and consumed. You have the expansion of renewable energy. You have the growth of electric vehicles. You have increasing demand for reliable power as data centers and AI infrastructure scale globally. All of that requires one thing: a stronger, smarter, and more resilient electrical grid. And Hubbell sits right in the middle of that transition. This is not a short-term trend. This is a multi-decade shift. So when you invest in a company like Hubbell, you are not just buying a stock. You are gaining exposure to one of the most important infrastructure upgrades happening in the world today. Now let's talk about the business itself. Hubbell has built a strong position in its market through a combination of engineering expertise, product reliability, and long-standing relationships with utilities and industrial customers. Just like with 𝗗𝗓𝗦𝗖𝗢𝗗𝗘, reliability is everything. When it comes to electrical infrastructure, failure can have massive consequences, so customers prioritize trusted suppliers. That creates a durable competitive advantage, and over time that translates into consistent demand and pricing power. Now here is where things get even more interesting. Hubbell has been benefiting from increased investment in grid modernization and electrification. Utilities are upgrading their systems to handle higher loads and integrate new energy sources. At the same time, industrial customers are investing in electrification and efficiency improvements. So you have demand coming from multiple directions. And this is reflected in the company's financial performance. Hubbell has delivered strong revenue growth, supported by both volume and pricing. Its margins have improved, showing that it is not just growing, but doing so efficiently. It also generates solid free cash flow, which allows it to reinvest in the business, return capital to shareholders, and strengthen its position over time. And this is key, because in a market like this, you want companies that are not just growing, but generating real cash. Now here is the bigger picture. When you combine 𝗗𝗂 with the other two companies we discussed, you start to see a very clear pattern. Each of these businesses operates in a critical area of the economy. Palantir is focused on data and decision-making. 𝗗𝗓𝗏 is focused on essential infrastructure like water and industrial systems. 𝗗𝗂 is focused on energy and electrical infrastructure. These are not trends that come and go. These are foundational layers of the economy, and that is exactly why they can win in this market. Because no matter what happens with interest rates, inflation, or geopolitical events, these areas continue to matter. Now let's connect this back to the bigger theme of the video. We are in a market where there is a lot of uncertainty, and when uncertainty is high, investors tend to either panic or chase short-term opportunities. But the real opportunity is often in identifying businesses that can perform across different environments. That is what these three companies represent. They have durable demand, they have strong competitive positions, and they are aligned with long-term trends. Now I want you to think about something. If the market becomes more volatile, which of these businesses is likely to still generate revenue? If the economy slows down, which of these businesses still provides essential services? If new technologies emerge, which of these businesses is positioned to benefit rather than be disrupted? These are the questions that matter. And when you look at Palantir, 𝗗𝗓𝗏, and 𝗗𝗂 through that lens, you start to see why they stand out. Now here is my personal take. I think a lot of investors are overcomplicating things right now. They are trying to predict every move of the Fed. They are reacting to every headline. They are constantly adjusting their strategy based on short-term noise. But the reality is, you do not need to predict everything. You just need to own the right businesses. And the right businesses are the ones that can grow, adapt, and generate cash over time. That is what creates long-term wealth. Now let's talk about how you can think about these stocks in your own portfolio. You do not need to go all in on any single idea. Instead, think about balance. Palantir gives you exposure to data and AI, which represents future growth. 𝗗𝗓𝗏 gives you stability and exposure to essential infrastructure. 𝗗𝗂 gives you a mix of growth and infrastructure tied to energy and electrification. Together they create a diversified approach that is not dependent on a single outcome. And that is powerful, because it allows you to participate in multiple trends while reducing risk. Now here is a question I want you to think about. Out of these three businesses, which one do you believe has the strongest long-term competitive advantage? Is it the data-driven model of Palantir, the steady infrastructure demand of 𝗗𝗓𝗏, or the electrification tailwind behind 𝗗𝗂? Let me know your answer in the comments, because I want to hear how you are thinking about these opportunities. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. At the end of the day, the market will always have uncertainty. There will always be new headlines, new risks, and new narratives. But the investors who succeed are the ones who focus on fundamentals. They look for businesses that solve real problems. They look for companies with strong positioning, and they think long-term. That is how you win in this market. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.